All right, we're going to give it just another minute here to let some people join on. It looks like we've got quite a few joining from our waiting room right now. So we'll just give it one more minute here and then we'll get things started. All right, well, I'm going to go ahead and kick things off. Hi, everyone, and good morning. I want to thank each and every one of you for joining us today for our webinar, Real World Lessons for Smarter Investments. Today, we will discuss ways to reframe volatility, challenge common misperceptions, and reinforce the principles of sound investing. We do have the Q&A feature available, so you can submit questions through that option. And if there's time at the end of this session, those questions will get addressed. You can also submit any questions to us via email at bschultz@yoursummit.com, and I will display that email address near the end of our session today. And now I would like to introduce our panelists joining us for the discussion today. First, we have Denis O'Donoghue. Denis started his career in finance working in investor relations for hedge funds in 2011. He transitioned to sales in 2016 on the retail side. Denis then made the jump to retirement side of the business in 2021 at Invesco, where he is now a regional retirement consultant. His goal is to make sure advisors and participants have all the resources they need to make sound financial decisions. Our second panelist, Brandon Schultz, is the Director of Operations for Investments at Summit. Brandon is approaching a decade of experience across investment, banking, and accounting industries. With this experience, he is able to bring knowledge to clients in multiple areas of their financial lives. Brandon is client-focused and values educating America's workforce on how to improve their financial lives as well as help them achieve their unique financial summit. And now I will pass it off to Brandon to get us started.
Great. Thank you, Matt. Thank you for the introductions there. And thank you all for joining, of course. I'm really excited about this webinar today, and I think it comes at a really great time. Interestingly enough, today the market started significantly down and has already recovered quite a bit. And there has been a lot of volatility recently to start the year. And really, I would say over the first half of the decade, it's really been a little bit volatile. But the word volatility takes on such a negative connotation. In reality, volatility can be on both the upside and the downside. So, I always call myself a realist. I'm not a negative person or necessarily a positive person. I'm a realist. And so I like to look at the reality of volatility, and it's not always a bad thing. And even though we've seen really throughout the entire history of the market there be volatility, it still ended in positive growth. And really, I think we're just blasted every day with negative news. I hear the term, if it bleeds, it leads. That's something that I've heard that I found interesting, because that's what grabs our attention, is the negative. But the truth is, nothing's never really as bad or as good as we think it is. And so, Dennis, I'm really excited this morning to, spread a little positivity with you, and as we take a look at, the realities of the market.
Yeah. I actually appreciate those sentiments. A lot of what you'll see here and a lot of the presentations we do kind of focus on staying in the game. Being in it and staying in it are the most important parts. Don't really get too spooked, and you'll see that as I as I walk through this. Let me just pull it up and we'll be ready to go. Now, can you see the presentation?
Absolutely.
Not the behind the scenes stuff, the presentation.
Not the behind the scenes stuff.
Okay,
yeah.
Great. Excellent. All right, great. Well, again, thank you for having me. My bio makes me seem a lot more impressive than I actually am, but it's very nice to be in front of you all and go through some of the resources that we have. This one in particular, Compelling Wealth Management Conversations. So hope you enjoy. We'll move on. So basically, excuse me. have a bit of a cold. Basically, we'll go over a couple different things. You see here principles of sound investing and historical context. Now, over the long term, stock market historically reflects the objective performance of the macro economy and the individual companies within that economy. Now, over the short term, however, the stock market often reflects human emotion, perceptions, and misperceptions. This book is designed to help provide philosophical and historical context and perspective. It's supposed to help keep clients buckled in and stay the course during uncertain times, while also providing a framework to help identify the best current opportunities. Now, when you listen to financial news commentators, and Brandon alluded to this earlier, it can feel as though financial markets and investment decisions are capricious and arbitrary. Over the short term, that may be accurate. However, over the long term, there are universal investment principles that may ultimately help govern your success and which guide all of our wealth management and investment decisions. Adhering to principles like balance, consistency, and courage may help keep us on course and provide a buffer from the constant drone of crisis and fear promoted by some news and media outlets. In our view, one of the most powerful principles is consistency. Yet, ironically, in today's society, it is the most consistently violated. Yo-yo dieting, a hit-or-miss exercise regimen, inconsistent prospecting, a reactive investment strategy. All of these examples have one thing in common. They each violate the principle of consistency. We work closely with our clients with the goal of establishing an overarching and highly personalized wealth management and investment strategy. We then exercise the principles of discipline and consistency in their long-term application, believing that this gives us the best opportunity to achieve long-term success in our clientele. So we believe the number one threat to your investment portfolio is unbridled emotion. More money may be lost due to fear and greed, how we respond, than all of the financial, economic, and geopolitical events combined. It's not the events themselves, but our response to the events that can cause the greatest harm. How harmful? The average investor doesn't come close to beating the S&P index in government-related bonds.
Yeah, and I think, Dennis, on that previous slide, I've seen that, specific slide play out, quite a bit. And one of my least favorite calls that I get is from a 20, 30, 40-year-old telling me that they've been in cash since COVID or since 2022, because in reality, I know they've missed out on so much market growth that could really boosted their retirement savings and timeline, significantly. And again, that's not to say that there's never a good reason to move to cash, but staying invested when everything around us kind of says differently is important, and we can really see that play out when we look at these years here, 1992 to 2022. If someone had been invested fully in the U.S. stock market versus what the average investor makes. And I think that's just people following trends, following what they hear. Again, the negativity in the news around us. But I think your next slide really shows, why it's important to, keep your path and try to keep that outside noise outside.
Absolutely. Couldn't agree more. I won't give a specific date as to give away any leanings or anything, but that happened to my parents because they didn't like a particular president. President doesn't matter. I'll tell you that. We have a great presentation on that, people care about the elections, markets don't. The important thing is staying in the game, and they lost out on a big run because of personal feelings, emotions, as we're saying. Yeah, you're absolutely right. Now, be wary of the herd mentality. From the tech boom, or the bubble as we called it back then, to the so-called fear trade, to the COVID-19 outbreak, investors have often positioned themselves poorly at the most inopportune times. So here's an analogy that we believe illustrates the single greatest challenge people face when dealing with the stock market. How do people respond when there's a significant markdown in prices at their favorite department store? They run into the store searching for bargains. How do they respond when there is a significant markdown in prices in the stock market? They often run out of the store and don't return until prices get back to full retail.
I love that. No, that's a great analogy.
Yep, absolutely. Cheap is good, even in the stock market. That's why we have value opportunities. Now, the most dramatic example of the folly of market timing is the chart on the left. Missing the 30 best days over that 30-year span dropped the investment return towards the average rate of inflation over that period. The best days in the stock market tended to cluster and are easily missed. 8 of the top 30 price return days for the US stocks since 1993 have happened during the COVID outbreak. 80% of the best days in the market over the past 30 years happened during the tech wreck, the financial crisis, and during the COVID outbreak. Now, markets form patterns because there are humans in the driver's seat. Even trading models are built by people. Investors try to squeeze insights out of data and shape it into a story, often without causation. This causes patterns to either persist or break, often without reason. Investors tend to enjoy a good slogan as well, the January effect, and sell in May and go away. Those are 2 of them that you may have heard. While both have proven successful at forecasting market patterns, the hook is that they aren't actionable. Putting actual money to work behind these patterns is a fool's errand that can cost millions. Now, this is one of my favorite slides. Is the stock market like a Vegas casino? Actually, no. Notice that the odds of winning any of the most popular games in Vegas never reach 50%. For comparison's sake, over rolling monthly 1-year holding periods, the stock market has been up 72.8% of the time. The longer the investor remained at the stock market table, the more likely they were to produce positive returns. Over rolling monthly 15-year periods, for example, January 1901 to January 1916, all the way up to December 2007 to December 2023, stocks were up 99.9% of the time, with the only 9 down periods coming during the Great Depression. Now, ironically, the longer you sit at a table in Vegas, the worse your odds get, because as we know, the house always wins.
Yeah, no, I would echo that this is probably one of my favorite slides in the presentation. I'm a little biased because we actually used this slide. We had a market volatility presentation that we used back after 2020 and 2021 in a lot of our education meetings. So some on the call might actually even remember this slide because they were there when I did it. But I found it really interesting. What we would do is we would have the odds of winning at the casino games blanked out, and we polled the crowd, what do you think game gave you the best opportunity to win? And nobody really said, Baccarat, which I wouldn't have either because I didn't know what in the world it was. So I actually did some research before we did these presentations. And I found out that, if you watch any James Bond movie before Casino Royale, the one with Daniel Craig when he started, when they were playing cards, pre those movies, they were playing Baccarat. And that's actually how the novels were written, is that James Bond was always playing Baccarat. And it's a really popular game worldwide, but the directors actually changed the game that they played to Texas Hold'em because at the time Casino Royale came out, it was blowing up. And I think it was ESPN had I feel like a Texas Hold'em tournament, every weekend on regular ESPN, not just like ESPN 8. And so, there's your useless fact for the day about Casino Royale and Baccarat. But it's crazy to think that, even the highest, rate of winning in a casino game doesn't even touch the U.S. market. But I do get, this question or objection to investing quite often. And so I love this slide, how it just shows that long-term play in investing really does make a difference. And the investor, is usually rewarded historically for staying in.
Absolutely. And that's great info. I would have thought it was blackjack, but
Yeah.
I guess it's baccarat. All right. In our view, historical perspective should inform and guide investment decisions. We believe maintaining that disciplined perspective often requires that we exercise the principle of courage during times of uncertainty and fear. Sorry, let's try and get to the next slide. There we go. All right. Market corrections happen often and even in the good years, including significant intra-year declines in recent strong return years like 2010, 2012, and 2020. From 1989 to 2023, the S&P 500 index experienced at least a 5% intra-year decline in every year but four. The median intra-year decline over the past 34 years has been negative 10%. But notice equities have still posted positive returns in 29 of those last 35 years, with median annualized total returns over that period of 14.4%. The bottom line is, market corrections do not equal a financial loss unless you sell. Now, stocks have outperformed most asset classes, outperforming bonds over rolling 15-year periods from 1979 to 2023. For example, January 1979 to December 1992, February 1979 to January 1993, all the way up to January 2008 to December 2022, 86% of the time. For investors with a growth objective, there are few, if any, better alternatives to stocks. Now, at the top of every mountain is a summit. A recent high in the market is often referred to as a peak. What isn't defined in markets, though, is the mountain range, and whether there are any taller mountains after the current one. History shows us there have been many previous peaks, and even after gaps of many years, taller ones have appeared.
Yeah, I mean, I think for me, I honestly do hear this barrier to investing quite often when people are talking about, I don't want to invest right now because the market's at a high. I do hear that one quite often, and I completely understand the sentiment. I mean, that it does make a lot of sense. You don't want to. We're even told, buy low, sell high. So, but I think it's an interesting slide, and especially looking at, really since 2010, 2011, how many market highs have been hit. And I just keep going back to, I love to tell the story when I was in college, which, in all reality wasn't that long ago. The S&P hit 2000. So it hit 2K when I was in college. And, I can still see the Wall Street Journal headline because back then I actually got the physical papers for our investment class. And I'm 32 years old. I say back then, like it was, the 1950s. But back then we got the physical paper, and I remember seeing, it had hit, 2000. But then we look today, and the S&P 500 is approaching 6,000. So it's incredible how much market growth we have had in the last few years. And, if I was one of those people that said, I'm just going to wait until the market goes down because we're at a high, I don't want to invest right now, how long would that last? And then also how much gain would I missed out on? So I love seeing this and showing just how many times the market hits a high. It's actually quite common for a market to hit an all-time high.
Yeah, I mean, imagine back in 1996 saying it's too high. I mean, look at that chart. Look at 1996. You'd be way out of the game. So taking a long-term view during times of crisis is often easier said than done, and of course, does not have a perfect track record. Still, we believe a key tenet in the principle of courage is to be greedy when others are fearful. As the charts show, investing in markets when others are fearful has arguably proved to be sage investment advice. Now, most stock market bears, like most actual bear encounters, might be a shock to the system, but are not actually life-threatening. Since 1945, there have been very few periods in which stocks fell by greater than 20%. In each of those instances, stocks inevitably recovered and climbed to new highs. Notice the commonality between these two charts. Bond prices remain relatively steady over time, regardless of the inevitable crisis that periodically hit the financial system. As the old saying goes, the difference between bonds and men is that bonds ultimately mature. The return from both categories of bonds comes from the income, not price appreciation. I actually love these sorts of charts. Let me see here, right here. Diversification across asset classes may keep investors from chasing last year's performance. As the chart illustrates, what works in one doesn't necessarily work in the subsequent years. Oftentimes, last year's outperformer falls to the bottom of the pack and vice versa. So don't put all your eggs in one basket, pretty much. Adding bonds to a portfolio may help to dampen the volatility of a portfolio and reduce the range of outcomes. So for historical context,
I just wanted to pause you because I love this next set of slides. I'm really a back of the baseball card kind of guy. Like I like the stats. I've always loved statistics, and I think these next few slides are just a great resource for positivity for our future. And so I just wanted to, level set here and say, I know we went through a lot of financial data, a lot about the markets, really good stuff. But when we look at the future and we look at just economic conditions and statistics, if you're like me and someone who likes statistics, you're going to find these next few slides very interesting.
Absolutely. Couldn't agree more. So for historical context, these insights may provide a much needed long-term perspective in a world of breaking news, as was alluded to earlier in the introduction, dire predictions and market volatility. In our view, what history shows us over and over again is the extraordinary resilience, creativity, invention, and innovation of mankind through the ages. We believe optimism is ultimately the only realism. Pessimism is counterintuitive because it rests on the concept of insoluble crises, which, the way we see it, simply doesn't square with the facts. If humans have shown one aptitude, it is the capacity to adapt and to learn. I mean, compare our response to the financial crisis of 2008 to the response of 1929. Pessimism is often framed around an exponential problem addressed by a linear solution. Human ingenuity, technological innovation, and the inherent limits of long-term forecasting appear to rarely be factored into the debate. Now, we believe the great underreported story of the last half century is the dramatic improvement of the human condition around the globe. But it's much easier to imagine a world in which everyone loses their jobs because of automation than a future where we're just doing something that is new, different, and is yet to have been dreamed up. It can be argued that jobs are now less labor intensive, require fewer resources, and are more lucrative than they were just a few decades ago. The migration from farm to office isn't new and hasn't stopped. While it is more mature in the US, it is just getting started in the emerging world. Now, global gross domestic product, or GDP, has exploded from 1.3 trillion in the 1960s to more than 101 trillion today, with the US making up a smaller share of the world's economic activity. The economic activity is being produced by only 2.5 times the number of people. As a result, the world has become significantly wealthier in a very short time. Now, I find this to be one of the more important slides in general for anything that we do. Now, for us, another great untold story of the last 2 centuries is the virtual elimination of extreme poverty around the globe. In 1820, virtually 95% of the world lived in extreme poverty, while today we have almost flipped those numbers. The link between economic freedom, which is the ability to control and own your intellectual, personal, and business property, and structural technological innovation, thank you, Walmart and Apple, to mention a couple, has often given ordinary people access to lifestyles only dreamed about less than a century ago, when the majority of governments had an iron grip on the economic levers within their societies. This is no small feat when you consider the previous 6,000 years of recorded history barely made a dent in these statistics. Now, the extraordinary achievements of the past 50 years were marked by a dramatic expansion in global literacy and a significant rise in the number of people around the world enjoying middle-class lifestyles. It is estimated that by 2025, half of the world's population will be in the ranks of the middle class. So compared to the golden days of the 1950s, the average American not only lives longer, but better. People are more highly educated, earn more money and work less for it, operate in safer conditions, are far healthier, and enjoy a much more luxurious lifestyle than their brethren in the 1950s could possibly have imagined.
Yeah, and I think the quality of life there is a big thing that we talk about when we're thinking about retirement planning or financial planning in general. You know, that number continues to climb on life expectancy, and I don't see, you know, anything that's going to stop that in the future. So we do get a lot of people thinking about, you know, if they're going to be living longer, you're you know, likely going to need to save more to not run out of money. But I think this is just such an interesting slide. And it's funny, I don't know if you remember a couple of years ago, there was you know, a graphic going around and it showed what an iPhone, you know, currently does, and it listed everything out. And then it showed another picture from the 1980s of what everything you would have to buy to actually replicate what the iPhone does. And I mean, part of it was because, you know, the iPhone's a little bit expensive. Let's be honest here. Getting a new iPhone isn't cheap at all. But, you know, they were showing, you know, the camcorder was, you know, a $300 purchase. A just actual camera was a $200 purchase. There was a calculator. There was the computer was an $800 purchase. So when you start adding everything up that you would have had to buy in the 1980s to replace your iPhone now, or whatever smartphone you use, it's just incredible. That changed my perspective. I actually never complain about when I go and get a new iPhone anymore, because, you know, I always remember that picture of how expensive it would have been to buy all the other stuff for my parents had to do when they were taking videos of and stuff of us as kids. So
yeah, absolutely. Yeah, and you're going from different store to different store, so there goes your time, which is money. So yeah, absolutely. And you know, this is something maybe for another day, but living longer is a very, very good point, especially when it comes to savings. Savings is extremely important because now your money has to last longer after you stop working. So you want to, you know, it's very, very important that you are conscious about, you know, having enough money for that longer, healthier life. I'll just leave that one up there. So, you know, hating the government is not an investment strategy. You know, but isn't a republic? I've actually, you know, alluded to this before. You know, kind of when I said my parents, because they disliked a certain president, got out of the game, and it cost them a lot of money. You know, but isn't a Republican president better for the market than a president from the Democratic Party? Well, not necessarily. In our view, there are far more important factors impacting both the economy and the stock market than which political party happens to occupy 1600 Pennsylvania Avenue. Investors considering waiting until the man or woman from their preferred political party occupies the White House should recognize how that would have worked out in the past. $10,000 investment held in the Dow Jones Industrial Average from 1896 to 2023 would now be worth more than $9 million. Incorporating a strategy where you own stocks, whatever your party is in the White House, and sell whenever the other party is in the White House would be worth more than $8 million less. But wouldn't we all be better off if the political parties were more cooperative and compromising and could get more accomplished? Again, not necessarily. Historically, the markets have done very well when there has been gridlock. I'm pretty sure the country was founded on that the government can't do much.
Yeah, no, I would, I know it's a sensitive subject, and one that we did a really I thought good webinar heading up to election season last year covering. I think we used a lot of your presentation on that as well, and or at least concepts from it. And it is so important, and we do live in a politically charged world, but I think these statistics are just so great in showing that long-term approach. And like you said, the believing in the U.S. economy has always proven to be a positive thing.
Yep, absolutely. And this next slide, this comes from what I mentioned before about people caring about the markets, people caring about elections and markets don't. So today, many potential investors use politics as a rationale for staying on the sidelines. They claim they will invest when their favorite politician or party gets elected, or when the latest policy-induced crisis is averted, like the fiscal cliff or the government shutdown. So what do the facts show? Since the Kennedy administration, the sitting president has been viewed unfavorably by more than half of the country 45% of the time. The reality is that over the past 63 years, the markets have performed best when the president's approval rating pulled somewhere between 35 to 50%. In short, hating the government should not inform an investment strategy. So the US federal government has far more assets than many realize. Rather than measuring debt as a percentage of GDP, which is primarily an income measure, measuring debt against total assets paints a far more solvent picture. If all the US government land, buildings, and natural resources were combined, the country would likely have more than $200 trillion in assets. While not all are liquid, they certainly paint the US as a much better creditor than many would believe. Now, when you look at technology through a historical lens, it has had one or more of the following four impacts. It compresses time, expands knowledge, personalizes experience, and or reduces costs, all of which, in our view, have had positive impacts on society as a whole. Compressed time, for example, travel time between New York and Chicago went from almost 6 weeks via wagon train to just around 2 hours today. Consider the remarkable impact on human productivity this compression of time has had. Expand knowledge. For most of human history, knowledge was passed verbally or individually in written form using parchment. With the advent of the Gutenberg press and later libraries, the average person had much greater access, but still had to travel some distance and burn a fair amount of time to find what they are looking for today. Today, you can sit in the privacy of your home and access information and knowledge that would have seemed miraculous just a few years ago, using the iPhone, as you had mentioned before. Personalized experience. Throughout most of history, whatever you wanted was in limited supply and on someone else's timetable. Whether going down to the local store and hoping they had what you wanted, to turning on the radio or television and listening to what they wanted to broadcast when they wanted to broadcast it. Today, you can find whatever you need whenever you want it. This is revolutionary. Reduce cost. Now, and finally, the cost of goods and services today is infinitesimal compared to years past. So you'll notice four things about this chart. One, that the average unemployment rate since 1870 has averaged 6.4%. Two, that the fluctuations in the annual unemployment rate can be volatile, but are uncorrelated to any major innovation or technology. 3, and finally, the two most important pieces due to the dramatic rise in per capita GDP are most productive and wealthier societies. And 4, which, of course, spurs the dramatic rise in personal income and much lower cost of average goods, which fosters a much higher standard of living. Throughout recorded time, economies that prosper have been in constant states of evolution and innovation, practicing a concept codified and popularized by the Austrian economist Joseph Schumpeter, creative destruction. This process revolutionizes the economic structure from within, incessantly destroying the old with the new. He argued that this process could be disruptive situationally over the short term. It is far outweighed by the benefits to society as a whole over the long term. Brandon, you were in school much more recently than me. Is Schumpeter something that came up for you guys?
I don't remember the name. I applaud you on the pronunciation though, but I would say the concept certainly, makes sense. And I think there was a slide previously you talked about that, sometimes we perceive the new technology or potentially, I know, people seeing things as well, machines are going to take over more jobs. And I know there was a lot of thought of that. I actually vaguely remember when the self-checkout was coming out and a really big thing, and there was a lot of thoughts that was going to take a lot of jobs, and so our perceptions about innovation sometimes tend to be negative on the front end of them, but I think this is a great point, and I love what that economist said about it, that destruction sometimes actually creates something much better.
Yeah, it's a funny example. I do remember that, and I remember people saying, well, if I'm doing it, why don't they pay me to work here? That sort of thing.
Yeah, I do
I
remember
remember
that as
that
well.
being thrown out a lot. Yeah.
Yeah.
So in 1798, Thomas Malthus made his legendary prediction: the power of population is infinitely greater than the power in the earth to produce subsistence for man. Doom and gloom forecasters always fail to factor in mankind's remarkable intellect and ingenuity. Now, Thomas Malthus, the godfather of all demographic and economic pessimists, stated in 1798, all the children born beyond what would be required to keep the population level must necessarily perish. In our view, that's pretty harsh. Here's a reality check. You could place the entire population of the globe, all 7.6 billion people, in the state of Texas, and it would have the population density of New York City. Maybe a little cramped, but not exactly uninhabitable. Now, whether or not we're big fans of kippers and Yorkshire pudding, we can likely all agree that the people of London are doing just fine. As a result of innovation, world grain production since 1960 has outpaced world population growth by over 100%. All these pessimists see geometric problems and linear solutions, when history demonstrates the majority of problems are, in fact, linear. I just thought that was a great stat, great point, fitting into Texas.
I was going to say, I mean, we talked about the Baccarat slide, which is definitely a good one, in the casino. But this was kind of the jaw-dropping slide for me when I first saw this presentation. The entire world population could fit in the state of Texas if it had the population density of New York is pretty mind-blowing, a perspective, I think. And so, yeah, I love this slide, and it's specifically that statistic. I just thought that was so interesting. Because I have heard, the world's running out of space, quite often. So, yeah, that's very interesting.
Right. Yeah, absolutely. Completely agree. Now we'll close to wrapping it up. Thomas Malthus, we'll wrap it up with this one, actually. So the concept of peak oil was first popularized by Marion Hubbard in 1956. Like so many pessimists, Hubbard failed to account for human ingenuity and extraordinary technological innovations. that in this case allow oil exploration companies to drill deeper and to uncover oil in less conventional places. Now, as a result, technological innovations have allowed land drilling depth to more than double in the last 70 years. Ocean drilling is even more dramatic, going from less than 1,000 feet pre-1975 to 16,686 feet in 2019. And combine this with the revolutionary technique of fracking, and we've gone from lines at the gas station in the 1970s to a virtual oil glut today. In our view, the long and short of it is that the world has more than enough energy resources to fuel the global economy for quite some time.
Yeah, fantastic stuff, Dennis. And I know wrapping up here, we're at about time. Thank you so much for your time today, Dennis. I know you just powered through a presentation while feeling under the weather, so I really appreciate you sticking in there, and thank you all to everyone that joined. I really do hope that you gained just one or two pieces of knowledge. I mean, just some of the stuff that we went through, I think are just fun statistics that I've honestly brought up to friends or something, just because I think they're cool. I mean, I know I'm a bit of a nerd and a finance nerd and that sort of thing, but I think they're pretty fascinating. But hopefully you gain one or two pieces of knowledge that'll help keep you on the path when we go through our next bear market or recession, which is going to happen. That is something that it will happen. And again, it's never as good or as bad as we perceive it to be. But if you ever need someone to talk to about your personal strategy, your investments, to help get a better understanding of what's happening in the market, we're happy to help review your investments, the options that you have with you, so you can help make more informed decisions. And I always tell everyone, that people are emotional about their money, which is completely understandable. It's your savings. It's what you've worked hard for. But it is our job to take that emotion out of it, and for us not to be emotional about your money, and help you see things potentially from a different perspective. So with that, again, thank you all so much for your time and joining. I'll turn it over to Matthew to close us out here.
Thank you,
Yeah,
everyone.
I'd like to thank both Dennis and Brandon for your time and for sharing this informative and valuable information with us today. And we'd also like to thank everyone on here that's joining today's session as well. And if you have any questions or would like to be connected with the resource here at Summit, please feel free to email bschultz@yoursummit.com, as we'd be happy to assist. And to look ahead, mark your calendars for our next quarterly education webinar, Ditch Debt and Boost Your Credit, which we look forward to holding on June 5th, 2025. Please be sure to follow us on social media to stay up to date on market trends, legislative updates, and tips and tricks to help you pursue your retirement goals. As always, thank you for joining and letting us help you reach your summit. Thanks.